Hello and welcome to the Mutual Fund Show. Well, the last few days, weeks, maybe months, a lot of you must be, for lack of a better word, disillusioned with your returns in funds, if in certain categories of funds, and you might be thinking that your investments haven't been the right choice. I frankly don't agree with that, but we'll talk about all of that over the course of the next few weeks as well. But here's one idea that seems to be gathering a bit of pace. I've spoken to three different fund managers, and all of them say that there is a possibility that with the introduction or the larger acceptance of multi-asset funds, there might be uh, well a probability or a solution available to people to maybe have a diversified portfolio in the truest sense. Now, we obviously do it when we are doing the investments ourselves. Can a mutual fund do it? Well, I guess multi-asset funds can do it. And we're in the midst of a new fund offer in the multi-asset fund category that Nippon India has started or is on with currently. And Manish Gunwani joins in to talk about that fund, this category, and what should investors largely expect now from mutual funds going ahead? Manish, so good having you. Thanks much for joining in. Hope all is safe. Okay, is Manish on mute? I don't know if everybody can. Okay, now I can hear you. Yeah. Okay, Manish, good having you. Thanks for joining in. What's your sense, Manish? First, can a broad brush on how are markets looking from an investment perspective, because that would directly tie in with the kind of returns that mutual funds at large can give.
Well, clearly, I think the market bounce back has surprised a lot of people back from March when things looked so gloomy. And I think a lot of factors are driven that. One is, of course, the unprecedented stimulus, monetary and fiscal in the developed side, US, Europe, etc. Two is, I think globally economy has recovered better than a lot of people were scared of. In fact, India, I think, is lagging a bit because obviously the lockdowns have gone on a bit longer than we thought. But China, Europe, etc., have come back quite well. So I think a lot of us have been surprised, especially at the last phase. I mean, given the steep fall, we did expect some bounce back. But beyond 10,000, 10,500 on the Nifty, things have started looking a bit stretched. Frankly, I'm a bit cautious in the near term, although I must say that if you look at stocks not from a March perspective, March 2020 perspective, more from a Jan 2018 perspective, a lot of the stocks, especially in the broader market, mid and small cap, they're down 50, 60, 70% still, and there is a lot of room to make money on 2 3 year basis. But the simple point is that on near term earnings, obviously, market is looking a bit stretched. On FY22 earnings, FY21 earnings obviously are a bit murky because of the first half being impacted so severely. But even on FY22 earnings, the market multiple is quite a bit above the average multiple. So I would think that the market would consolidate here for some time. Mid to long term, I still find a lot of stocks offering good value, but I think you need patience with this market now.
Okay. Now, how does one then try and exercise this part optimism, part caution via the mutual fund route? Now, the last 12 months, Manish, when I've seen people come on the mutual fund show, there's been some bit of acceptance of multi-cap funds because they give you exposure across the categories. Now, is this larger acceptance and chatter around multi-cap funds trying to take that step a bit further, that you get multi-assets, you get multi-geographies, and you get multiple caps?
Yeah, I mean, see, as a nation evolves, as the country grows up, obviously the financial assets grow faster, and then people want exposure to different types of assets. Second is, I think macro forecasting is becoming very difficult, right? I mean, if you go back to October 2019, after the US-China trade war, global economy had started picking up, Indian economy had started picking up, and then suddenly out of the blue, you get something like COVID, which for some asset classes like equity is bad because it destroys earnings. And obviously something like gold does phenomenally well. So I think as people find the need to deploy money, um, we need to find different asset classes which meet that requirement. And clearly, what we are seeing is in a low interest rate world, in a low inflation world, the need for stable, low volatility returns. There is obviously a big need for that. It is showing up in the premium for even defensive stocks globally. So that's why we felt that by combining different asset classes, which are largely uncorrelated, that is, they work at different points of time, we can deliver reasonably steady return with low volatility, which I think is a big requirement for a lot of investors at this point of time.
Interesting. Manish, just trying to understand from a perspective of somebody who runs this whole equity side at Nippon, how would you, I mean, I'm guessing it would be difficult to even try and comprehend what's happening bottoms up within the equity space of a large nation like India, right? Now, how does a house kind of corroborate all these data, one Indian investments, international investments, commodity investments, and try and fit them into all investors' profile, so to say? Or not profile really, that's a bad word, but somebody,
Yeah.
one person's investment into a multi-strategy fund.
So I think we're trying to keep it simple, in fact. So, for example, on the foreign equity side, we're basically replicating the big global index there. We're not trying to pick stocks. Um, Commodities, we are largely in gold. We're not trying to be very opportunistic in commodities by, shifting the entire investment from one commodity to another. Even on the domestic equities, on the debt side, we have fairly what I would say low active share kind of products in this fund, so that the asset return does not get diluted too much beyond a point. So what we're trying to balance is a steady asset allocation level. So we don't change the asset allocation in this fund. Our point is that the weights of the asset classes are largely in line with the long-term returns promised by those assets. And once we've done that, we don't want to change the weights of the asset classes. But within the asset classes, we are being active to a certain extent, but that activeness, if I may call it that, is a bit controlled, so that the main emphasis is on the asset class return, and we don't get a situation where our portfolios diverge too much from the asset class. So I think we try to strike a good balance between how active we are versus how passive we are in this product, so that, as I said, the idea is that you get steady return with low volatility and you get good diversification. So, for example, with balanced funds or with dynamic asset allocation funds, which we see in the market right now, end of the day, those are Indian assets, rupee assets, right? Now, once you have foreign equities and commodities, you get a bit of diversification in terms of years like 2013 or 2018 when, let's say, rupee depreciates a lot. You get some hedge against currency depreciation as well. So we believe that the diversification capability of the product is a bit more richer than pure domestic asset classes.
Um, Manish, would you reckon that this would, or I mean, I'm just asking you whether this category of funds, even would it be a first stop category? Because again, the reason why I ask is you is in the last 3 months, almost everybody and their aunt comes out and says that, hey, if you are 100% invested in equities, this is a learning for you that you shouldn't be. And therefore, my question to you is that should this be a first port stop for somebody who's starting into mutual funds, or should one start off with domestic large caps or domestic multi caps, then get into debt funds, and then eventually get into a category like this? What do you think?
So I think the way investors should think about it is more, where are you ending up in the end, right? I mean, see, with this product, you have a certain amount of domestic equity. With a large cap product, you're 100% domestic equity. So overall, first of all, I think people should build their portfolios in terms of how much is the end asset class you're owning, whether it's equities or debt or commodities, etc. Having said that, we believe that this can be a big part of the portfolio core product, because essentially at one shot you get access to four big asset classes. And believe you me, a lot of people say, oh, we can do this asset class ourselves with one pure equity fund. We can do a gold fund. But when you look at the AUM of international funds and gold funds, you will clearly find that Indian households are massively underinvested in these asset classes. We don't expect Indian households to be 40% in foreign equities. But if you were to take the AUM of international funds, they are a minuscule fraction of the overall AUM, which basically suggests that a lot of Indian households have not invested in this asset class broadly, and therefore there is a gap. And this gives you a lot of convenience, right? Because one of the reasons I think people don't invest in international funds or commodities is there is a bit of cumbersome process. People feel they don't understand this, but I think beyond a point, you have to look at the correlation of the asset classes more than trying to be very bottom up in an asset class. And therefore, we do believe that this should be a big part of the portfolio, because this kind of gives you a foundation on which you can add a lot of pure equity funds, sectoral funds, thematic funds, which tend to be much more volatile, of course. But clearly, the big allocation in any portfolio has to be steady return, low volatile products.
Mm. And Manish, would you be slightly different from the other funds in this category in India? In that, because I heard you say that in your case at least, other than the Indian equities, the other three categories seem to be passive in nature. Am I correct? And therefore, would you be different than the others, or would funds largely be following this route? Any idea?
No, so we, I think, are definitely different in terms of having these four asset classes. Most of the other products tend to have two or three asset classes. And our strategy is as per the asset class. So domestic equities, we are active. Short debt, we are active, but with a lot of guidelines around what kind of paper we'll hold. In international equities, we are basically mimicking a global index, but we are compressing that because the global index has more than 1,000 stocks. So we're compressing that to a smaller number of stocks, like 25. And commodities, what we're saying is 15% in commodities, out of which 10% will always be gold. So the big opportunity is basically where we will be dynamic is only 5%. But gold, again, you can hold it through different forms to maximize your returns. So as I said, it's a balance between being active with a framework of risk you can take, and passive in terms of the fact that the asset levels. So domestic equities will always be 50%, foreign equities will always be 20%, debt will always be 15%, and commodities will always be 15%. So that is fixed. So within asset class, we're trying to add a bit of value from being active.
Okay. So last question, Manish. Then, if, let's assume that you are invested in this domestic equities, which is discretionary in nature and not passive. Should that weightage go up? As a rule, you would bring it down, or would this be rule based, or would this be at the discretion of somebody?
That's a point, and I think that's an important part of the fund construct, that we will do quarterly rebalance, because that will help us maintain valuation discipline as well. So, for example, at the beginning of the quarter, if domestic equity is 50% and let's say foreign equity is 20%, and let's assume Indian market outperforms global markets, what we will find at the end of the quarter, let's say domestic equities has become 53 and foreign equities has become 17 from 20%. Then end of the quarter, we will rebalance so that we are selling off something which has done well, and we are buying something which has not done well. So I think that will also help us, as I said, maintain as the valuation discipline, because over long term, asset classes revert to the mean. So this will be an important construct of the product. Yes.
Okay. Manish, we wish you all the best with the fun. Thanks so much for taking the time out and speaking to us today and giving us an idea of the NFO.
Thank you. Thanks for having me.
The pleasure is ours. Well, that's Manish Gunwani on the NFO that is on currently. I think it ends at August 22nd. So you can figure out if you thought that this was good enough for you to try and go out and invest in a product like this. If you want, well, let's get in somebody who looks at this category very closely. Keertan Shah needs no introduction, really a fairly popular figure in the investment advisory community and pretty active on social media, if I'm not wrong, and he joins us right down the road. Keertan, good having you. Thanks for joining in. Appreciate your time. Hope all is safe.
Thank you so much for having me.
Okay. I'm guessing all is safe, Keertan. Before we get to the NFO, Keertan, just a thought on this category as well, because like I was asking Manish, I don't know, you got probably got a chance to hear too, that people, the last 12 months, at least I thought, a lot of people started accepting multi-caps because there was a bit of a diversification from pure large cap or pure mid cap or pure small cap, or balancing, rebalancing of sorts. And now we are talking about this category. 2 weeks ago, Sandeep Tandon of Quant MF also came and said that they are seeing a lot of traction in the multi-asset fund category. What are your thoughts on this?
See, I think to keep it very basic, Neeraj, as per SEBI's definition, while multi-asset funds have to keep 10% minimum in equity, now that can be domestic or international, is because both are comprised as equity as per SEBI definition. And you should have 10% in debt and 10% in gold. Now, this is what the SEBI definition highly focuses on in terms of structure. Now, of course, because all of these asset classes have very little correlation or negative correlation in some cases, of course, this tends to make a very good basket of a portfolio of unrelated assets. And probably over a period of time, the risk-adjusted returns may turn out to be really decent versus some other independent asset class investment, and can also reduce drawdowns. That is for sure. But I have a small apprehension the way most of us talk about these funds, saying that this will take care of asset allocation. In my opinion, asset allocation as a strategy has to be taken care of at the client level, and it cannot be taken care of at the fund level. What I really mean by that is you cannot have 10,000, 20,000 clients invested in a particular fund and then expect that the fund will take care of the asset allocation strategy of all of those clients invested in the product. Of course, this particular fund can be a part of your overall asset allocation or investment strategy, but this cannot be an asset allocation product in itself, in my opinion.
Why would you say that, Keertan? And the reason I asked this question to you is, I mean, just trying to play the devil's advocate here, that I'm a person residing in Mumbai, but don't quite understand. I mean, I'm doing a job. I don't quite have time for Indian equities itself. So I don't definitely have time to understand commodities or currency or international equities. And therefore, instead of trying to pick and choose each of these asset classes and trying to time, etc., 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 I have a product which does this for me. Why is that not a compelling argument?
So, Neeraj, in this, it is not more to do with timing of the asset, but the allocation of the asset in itself.
Allocation too.
Yeah. So, what do I mean when I say this? Is, let's say, for example, there is a conservative client who would not want a 70-80% allocation to equity, irrespective of how risk-adjusted return may turn out in the future. But at the same time, an aggressive client who would want to invest would have a 70-80% asset allocation towards equity. Now, if both of these clients are going to be a part of this particular fund, which is going to move asset allocation anywhere in the range of, let's say, 10% equity to 80% equity, at the fund level, it might be correct where the fund manager is taking a prudent call of, while whether the equity is undervalued and I should be overweight on equity, or equity is overvalued and I should be underweight on equity. It does not solve the asset allocation purpose for somebody at the client level. So as a conservative client, even if the equities are cheap, I may not be very comfortable with 70 or 80% of my portfolio in equity. And which is why I said that, this can be a part of your overall asset allocation strategy. This may not be a one product fit all for all kinds of things.
No, that I completely agree. But I'm just sorry, just so that I get this clear. When I look at the indicative asset allocation that Nippon India Multi-Asset Fund at least is saying, and then I would want to talk about the others too. They are saying that domestic plus international equity will be 50 to 80%. So they're not talking of taking equities down to 10% any which ways, right? So if I'm comfortable having my overall equity exposure above 50% and want asset allocation while not having the time to look at all the other asset classes myself, does this give you an option? Or this
Absolutely.
or any other?
In that case, this definitely gives you an option. But if
Okay.
I have to talk about anything outside of Nippon, you know what is happening in entire category.
Okay.
Unfortunately, though it is a multi-asset kind of a category, this is more equity focused. So if you look at most of these other funds outside of Motilal Oswal fund that got launched the last month, most of these funds are equity heavy, and they have a very little debt exposure or a very little gold exposure. And which is why, in my opinion, this does not solve the purpose of an entire multi-asset rebalancing kind of a strategy, but it is more of an equity-focused fund with a little bit of debt and a little bit of gold.
Okay, so are you okay? I'm just trying to understand, Ketan. One more question, just as a novice, I'm asking you. When I'm looking at the other categories, and correct me if I'm wrong here, but I'm looking at the 4 or 5 other mutual fund houses, right? So ICICI Prudential Multi-Asset or SBI Multi-Asset Allocation Fund or Motilal Oswal for that matter, their equity exposure ranges from 10% to 50% or 10% to 80%, in which case they are probably not very heavy on the equity side. They're just leaving a lot of range. So is your issue with the fact that they are heavy on the equity side, or is the issue that because the ranges are so high that they could whittle it down to 10% also and bring it down to 60, 70% also, and therefore there is no clarity?
So Neeraj, what is happening is, for all technical purposes, though while the objective of the scheme and the SEBI definition will say 10% to 80%, there is a big caveat here, is that if your fund goes down below 65% on the equity allocation, you don't get equity taxation. Now, to suffice this point, or to suffice this equity taxation that you really want to end up giving to clients who invest in the funds, most of these funds, for all the historical performances that you look at, have always been higher than 65% on the equity side. So my entire discuss here is that, though the objective of the fund might say that I have a higher range of 10 to 80%, for all practical purposes over the last 3 years, 5 years, that you see most of these funds have been equity heavy with 65% plus exposure to equity, because that will give an equity taxation to the client. And hence, it is not actually a proper diversified portfolio that we are really looking at while we are talking about a multi-asset fund.
Okay. Now, Ketan, one small follow-up, and then I would want you to talk about what your experience has been with these funds over the other funds in the last 3-5 years. But one small question. Now, people who are coming to advisors such as yours, and you can advise them, great. But there are a lot of people, let's say tier 2, tier 3, etc., do not have an advisor, do not want to go to an advisor. I'm just thinking from that perspective, and therefore they do not have any kind of global diversification or commodity diversification. So for that category, would this, even if it's only less than 35%, still be an option? I'm just trying to think from that client's perspective. Otherwise, yeah, by your point that people maybe should go to an advisor or try and understand the asset allocation strategy themselves as well. But for the other variety that I spoke about, would this be an option?
Absolutely. See, I think I'm absolutely in for why multi-asset funds are a great product, right? Is because somebody like the one that you pointed out, who does not have the understanding or the bandwidth to understand domestic, international, gold, debt separately, this is a brilliant product. So if I have to really boil it down and make it very simple, so let's say, for example, if there is a client who understands that I'm conservative, I think a Motilal Oswal fund that came out the last month makes a lot of sense. And then there is a client who understands that, I am slightly on the aggressive part. I think the Nippon fund makes a lot of sense. It's because they're completely different in their fund construct. Both of these funds will give exposure to gold, domestic equity, international equity, as well as debt. But the way the funds are constructed, I think the Motilal fund makes more sense for a conservative client, and the Nippon fund makes more sense to a moderate to an aggressive client.
Okay, viewers, keep in mind, I think one of the reasons why Ketan might be saying this is because Motilal Oswal equity is 10 to 50%, and which is why I think he's using the terms conservative, versus Nippon, which is 50 to 80% in equity, and therefore an aggressive stance. Now, Ketan, Nippon is of course the NFO, but there are funds like these which have existed in this category in the past. Anything that you think these funds have not done, which they could have done in your observation to give better returns and better quality of returns to investors?
See, I think there are three disconnects that I really have with the existing funds so far. Then I'm not talking about the NFOs. I think the first disconnect that I already pointed out to you is, for me, these are pseudo equity funds. So what most of these funds have done is kept equity exposure above 65% and up to 80%, like the investment objective says, just to give that equity taxation to the client. And to a certain extent, I feel, given the way these funds are constructed with 65-80% equity exposure, I think what we are trying to do is not give a multi-asset kind of an exposure, but try and compete with a balance advantage or a dynamic asset allocation kind of a category in the market, which I think I'm not very comfortable with looking at the funds there. The second, very important point that I really want to drive here is that if we look at the existing funds, most of these funds do not have a rule-based approach, and all of these funds are discretionary funds. Now, what I really mean by that is, because they have 10 to 80% exposure that they can take in equities, or for that matter, 10 to 50% exposure that they can take in debt, or 10 to 25% exposure that they can take in gold, depending on the objective of the fund. I think if you look at these schemes very closely over the 3 or 5 year period, I think what these schemes are doing is chase performance. And most of these funds have not been rule-based, which is why if you look at their returns very closely, calendar-wise and CAGR over 3 or 5 years, you would understand that all of these funds have very, very, very different return perspectives. Like, say, for example, if you look at the last 1 year, up to July 30th, you would understand that there are funds which have given, in the same category, 2.76% return in 1 year, but the funds have given another fund has given close to 16% in the same year. So if it's the same asset class or the same category of multi-assets that we are talking about, this divergence of one fund giving 2%, 2.5%, and another fund giving 16% in the same category, in itself shows that there is a rule-based model approach that everybody is using, but discretionary model. And that is, I think, is a big drawback of the existing funds in this category, in my opinion, that I've observed over 3 years, 5 years.
Got it. Okay, Keithan, valid points, all of these, and thank you so much for bringing that out as well. And it's important to see that, viewers, I think, and Keithan, of course, thank you so much for joining me today on the Mutual Fund Show. We look forward to having you more often on this platform.
Thank you so much, Neeraj, for having me.
Yeah, and viewers, remember, so I think the derivation of this show is that it's a category that is interesting, and if you indeed have ability to take the exposure yourself, then the advisor suggests that maybe it's a better thing to do asset allocation in that fashion, because a lot of these funds are equity heavy. But otherwise, there are options within this category as well of mutual funds, and you can choose, because there's a Motilal Oswal fund which has a maximum exposure of 50% to equity. Nippon is 50 to 80%, so the minimum is 50%. So depending on what kind of an investor you are, you could probably look at these funds for a simplistic investment approach to asset allocation in its truest sense, because you get exposure to Indian equity, international equity, commodities, and debt market and money market instruments, all in one. So please do your homework though, and then try and go out and invest, whether in this NFO or in this category. But looks an interesting one. Thanks so much for tuning into the Mutual Fund Show.